So today we're looking at a classified balance sheet that has an expanded fixed asset section as well as an expanded owner's equity section. And we're going to look at three possible scenarios in the owner's equity section. So to start off, there's current assets section that's listed in the order of liquidity, which is how easily an asset is converted into cash, and all the current assets are to be used within a year. For fixed assets, in the expanded section, we're going to take away any depreciation that we've calculated on those assets. So you'll notice there's a third column, and the first column is where you will place the value of the asset at historical cost less the amortization. And the balance called net book value goes in the middle column. And so after you've listed all your fixed assets, which are listed in order of most permanent to least permanent. So in this case, we have land, then buildings, then a truck. All the net book values will be in the middle column, and the total will appear in the far right-hand column. Okay, and of course, we have our total assets, which is the current assets plus the value of our fixed assets at $318,000. In the liability section, we have our current liabilities. We have an accounts payable control account, so we're not listing individual accounts payable accounts. It's the full balance of all accounts payables that the company has. Okay, and that is placed in the middle column. Then we have to figure out if we have HST payable or recoverable. In this case, our payable amount is greater than our recoverable amount, so we have to add that to our accounts payable balance, and here are our total current liabilities. In our long-term liability section, we have a loan and a mortgage to pay off. Those balances are first listed in the middle column and the total in the far right. Now, for expanded owner's equity section, you start with the owner's account, capital account. So the first initial dot the last name, comma, capital. You indent the balance on the first day of this fiscal period. Okay, so the balance is July. It should actually say July 1st. So that balance is placed in the middle column. Then we have, in this case, net income of $40,000, which we have to take away drawings that the owner with the money that owner withdrew from the business. And overall, we have an increase in capital. So here we're going to add that to our beginning balance in our capital account to find our new balance June 30th of the following year. Okay, so our total, we add up all of our liabilities and owner's equity to balance our sheet. Now we are going to look at the expanded equity section for a business where the drawings are greater than the net income that was generated. So you're going to take the difference between net income and drawings, and the difference here is negative $7,125. So overall, we're going to have a decrease in capital by that amount. So you're going to take away the $7,000 from your opening capital balance of $119,000 to arrive at your new ending balance for the capital account of $112,000. Okay, and then you would again add up your current liabilities, long-term liabilities, and your owner's equity balance, your capital balance, which is $318,000, and make sure that that balances your total assets. A third situation where you might encounter is where you have a net loss for the business for the fiscal period, and the owner has also taken drawings out of the business. So you're going to add the net loss and drawings balances, and you'll have an overall decrease in capital in this situation of $22,000. So you will deduct that from your opening capital balance to arrive at your new capital balance for the year.